Generic drug maker Aspen Pharmacare, as I said, reported a 24% rise in annual headline earnings per share. That's to 482.9 cents, boosted by the stronger rand and a solid performance at its South African unit. Revenue climbed 20% to 10.15 billion rand, while Aspen declared a dividend for the first time in 2 years of 70 cents a share. The group said it has successfully integrated the South African unit of GlaxoSmithKline with increased market share in the branded product sector. The pharmaceutical manufacturer announced last month that it would buy the drug-making arm of Australia's Sigma Pharmaceuticals for some $800 million US. This as it looks to boost its presence in that country and push further in the fast-growing Asia-Pacific region. Joining me now in studio to discuss the numbers further is CEO Stephen Saad and Kevin Algio from Imara SP Reid, who joins us on the market guest desk today. Thanks very much, gentlemen, for your time. Stephen, what can I say? Another good set of numbers. Your share price is up 22% since the beginning of the year. The market is celebrating these numbers out today, up 2%, closing at 91 Rand. And you've had a very strong performance, as we pointed out, in the South African space, despite the competition from the likes of Cipla, MedPro, and also Adcock Ingram becoming a little bit more aggressive. Is there still big growth opportunity in South Africa for you?
I think there's very big growth opportunity for us in South Africa. If you look at the market itself, the biggest section of the market by value actually is in the branded sector, followed by OTC, followed by generics. But I did a trend over the last 9 or 10 years, and generics has grown twice as fast as those two sectors. The OTCs have lagged a bit, but there is a lot of growth still. There's a lot of growth because there's more increased access to diagnosis in South Africa. That's been a big issue. People who didn't know they had diabetes and blood pressure are now finding out about it. And they expect those chronic diseases to double. And Aspen are particularly strong around chronic diseases. But of course, because there's increased use, I mean, there's people aging. And in South Africa, we've got young people who are on ARVs and who are sick. So there's big growth in volume. And of course, that's going to put a lot of pressure on price. People want a lower price, but they're not prepared to compromise quality. And I think that's the one big advantage we have over all of our competitors. So I think our profit in pharmaceuticals grew by 56% and our revenue grew by 40%. So I think it's been a really good performance, but I think there's still quite a bit to come.
You do think there's still quite a bit to come?
Yeah.
You've bettered down your relationship with Glaxo, and knowing that that all happened December 2009 was put to bed. And of course, the proverbial question is, how close are you and Glaxo going to become? I'm not sure if you can reveal any secrets on
No,
the desk.
I wouldn't. There aren't any secrets to reveal. You know, we are very close to Glaxo. They've been a big part of what we've done together, and a lot of our success has been, you know, had dependability, knowing they've got good, credible brands, and they're a good partner to have. And so it's very good to have someone from Glaxo who does international markets on our board to be able to share thoughts on markets like Colombia or Venezuela, etc., and hopefully not repeat some of the errors. But we are very close to Glaxo in our workings, but that's where it is. I mean, I think that's where it is right now.
Kevin, one more question before you can jump in, but the resumption of the dividend, and I'm assuming that that's why the market is so excited today in terms of your share price up 2%. You haven't paid a dividend for 2 years. You must be feeling rather bullish about the environment to be resuming a dividend payout. Would that be a fair assumption?
Absolutely fair assumption. I mean, we know we've got $900 million to pay for Sigma, and that's going to be coming up shortly, we hope. So there's a lot of money that we have to. The fact that we're paying that dividend is probably the standout feature in our results has been the cash generation in this business. And we've done that for 12 years, and we've continued to do it. But it's even surpassed some of our expectations. And as a result, we were able to bring a capital distribution back online.
Kevin, from your perspective, any burning questions for Stephen?
Yeah, excellent set of results. You mentioned your manufacturing hub here in South Africa, and gives you a competitive advantage. Why is that? What makes it so good?
Everything, I mean, in our business, it's people and technologies. But South Africa, I believe, is a competitive manufacturing base. And I can say it because we've got facilities in Germany, and we've got facilities in Brazil, and we've got facilities in Mexico. But South Africa is a compelling base, and we manufacture in India as well. So it's a compelling base, but you need the right people. And the advantage we have is economies of scale. And big economies of scale, going to automated facilities, it's actually driving costs down further and further and further. And our facilities have been a big part of driving the growth in our operating profit in South Africa.
And Rand strength helps you?
Rand strength helps us in South Africa only, but it really works against us on international business in Rand terms.
So probably net neutral then for
we
the
are
overall
We
group?
are probably a net neutral. I would say that we'd probably prefer a weaker Rand. But there's a lot of baskets of currencies in this, so it's a very general comment, but we largely are hedged as the currency was. I think if we didn't have ARVs in South Africa, which we're big importers of the chemical, and it's very expensive, we definitely would favour a weaker Rand.
One of your key challenges is obviously regulation, and specifically in emerging markets like South Africa. I see that regulated prices coming down in Australia as well. How do you face that headwind? Because it's one of the aspects that shareholders or potential shareholders of Aspen will throw forward and say, hang on a minute, stay away from the pharmaceuticals because the regulatory environment is uncertain.
The regulatory environment is uncertain, and managing the regulators is part of what we do. So I think if you're in education or healthcare, you're going to have a regulator or housing in your face. The trick is to say, well, what does a regulator want? What does he need? And the pressures I've told you are in emerging markets, the pressure is always going to be around pricing. So if you have a very competitive manufacturing base, so you have a very efficient cost of goods and a worldwide competitive cost of goods, you have a quality product that's affordable, which we've really positioned our generic offering. We exactly where the regulator wants to get to, wants to be. How many generics can I push and not compromise quality? So I think we're comfortable with where regulators are. In fact, regulators are driving people to where we are. What it does do is there's a lot of competition in our space, of course.
And LATAM territory, it looks as though you're still experiencing some trouble in that space. Can you give us an update?
Well, LATAM has been, LATAM for me is the most exciting territory of all the basket territories that we have as a business. It's by far, it's got the highest risk, the highest rewards, but I think that it's a territory from an Aspen perspective that we can overperform in. So at the 6 months when we spoke then, Bronwyn, I told you that we'd lost money in Latin America. We had a plan, but it's not for the faint-hearted. In the next 6 months, we actually have turned it around. Our turnover's up 30%. It's now profitable. It's working. We're working towards a plan. And most importantly, it's a more sustainable plan. We shift from a public sector business, which we inherited, to more of a private sector focus. Our own organic products are being registered, and we've taken some nice opportunities in that private sector.
But you're still saying it's not for the faint-hearted?
Absolutely not for the faint-hearted.
It's a tough market to operate in.
All those emerging markets are tough markets. Venezuela we're doing well in, Mexico, and you know, they're all tough markets, but each market requires a different plan. I mean, we had some troubles in sub-Saharan Africa, but you know, you've got to manage them. They're difficult markets, and that's what makes it difficult for multinationals to run these businesses. You need to be decisive, you need to have flexibility, and you need to move very quickly and make decisions quickly. You can't have huge, hana sessions. It won't work.
Update on Sigma Pharmaceuticals and your aggressive strategy into Asia Pacific.
Yeah. Okay, Sigma is I think a very compelling case for Aspen. The Sigma business, a 98-year-old business in Sigma, I would call it something similar to South African Druggist was when we acquired it in the South African environment. It has a wholesaling arm. It has a pharma business with generics, branded OTCs. We're very strong in the branded space in Australia. We supply currently our businesses. We've been there for 9 years now. We've had double-digit growth every year, 19% sales, good, strong management team. I think they can acquire the branded section easily. But I think the real opportunity is around generics. We can get 20 to 25% market share, strong distribution channel, and it needs fixing. There's no doubt about it needs fixing, but I think we have the skills globally around manufacturing, procurement, because it's really around cost of goods, because as you said, it's no use whining about the regulator and saying the regulator ain't going to increase your price, so best you fix your costs. So, and we've got that capability and ability, and we think it's a really compelling story for us.
Kevin, I've always got 20 questions. I store them up every 6 months for Stephen. So anything from your side before we let him go?
There was a bit of criticism about Sigma initially, especially from some of the market analysts. How do you manage that conflict? The criticism when you're wanting to make an acquisition to convince Sigma shareholders to sell to you.
Okay, well, the criticism, there's criticism of what Aspen does. We got criticized for doing the GSK deal. We've been criticized a lot historically. I only do what's I believe is in the best interest of the shareholders. I'm a big shareholder myself. So I think any shareholder in Aspen knows that if we're looking at Sigma, we think there's an opportunity. It's a lot of money, so we're going to make sure it better give a decent return. In terms of trying to manage shareholder sentiment, it is quite a tough tough story because I've got to tell my shareholders I think it's quite a good deal, and at the same time Sigma saying we want more money and you say it's a good deal. So I think we got to a stage, I mean, I would call the negotiations robust, to say the least. There was no punches pulled. Australians generally don't pull too many punches, and certainly I'm a pretty straight shooter myself. So, but it was a healthy argument, healthy debate, and I think they've got fair value for their shareholders and their capabilities of what they can do with that business. And the values we need to extract are those values where we have synergistic benefits and skills that I believe they don't have within their current structures.